Because existing home sales expanding 3.1% in January, and that's to a seasonally adjusted rate of just about 4 million. Sales, though, did decline 1.7% from a year ago. And Brad, when you take a look at some of these other numbers that we're getting, the median existing home sales price, that's up 5% from January of a year ago to $379,100. Not exactly a huge surprise. We've been talking, you and I, about the fact that inventory remains extremely limited. People are locked into those lower rates. They're not putting their homes on the market. As a result, those buyers that are still looking to purchase either their first home or a new home there are bidding up some of the prices here. And many of these homes are selling for much more than they would have a year or two ago.
Yeah, it's me. Hi, I'm the problem. It's me. I'm trying to get in the market. Can't do it right now. According to Freddie Mac, also within this result, the 30-year fixed rate mortgage averaged 6.77% as of February 15th. That's up from about 6.64% the previous week, 6.32% 1 year ago. Just lastly, and I'll end on this, we got a comment here from the National Association of Realtors chief economist Lawrence Yoon, good friend of the show here, and he ultimately said that while home sales remain sizably lower than a couple of years ago, January's monthly gain is the start of more supply and demand. Listings modestly higher, home buyers taking advantage of lower mortgage rates compared, again, though, to last year here. So we'll continue to watch and monitor where those rates are starting to tick back up on the mortgage side, according to some data from Freddie Mac. Also here, staying on the home front, existing home sales, they declined 1.7% from last year, but inventory of unsold existing homes rose 2% from a year ago as supply challenges and higher mortgage rates continue to impact home buyers. Let's bring in Brad Case, who's the Middleburg Communities chief economist, to weigh in on these numbers. Brad, I just want to get your take and your read here on this existing home sales print rising 3.1% during the month of January.
Well, this is good news. You know, I've been a little bit concerned about the single family home market because we've seen prices for existing homes decline over the last several months. As you noted, they're above where they were a year ago, but the last few months have been weak. The number of sales, of course, has been very weak, and we need to see a healthier housing market to support the entire economy. And so this print does give us some hope that the owner-occupied housing market is not going to drag down the rest of the economy. I had been looking at this and thinking, wow, we haven't seen anything like this since the mortgage market meltdown of 2005, 6, 7, 8. But this month's data looks a little bit less like that problem.
Hey, Brad, when it comes to exactly what it's going to take here to turn it around, I think a lot of people are out there asking about the timeline of this when it comes to that recovery, what that trajectory looks like. What are you anticipating once the Fed does potentially cut rates? What does that recovery timeline look like?
Well, I don't think that we should plan for the Fed to cut rates anytime soon. And that will, of course, mean that mortgage rates won't come down very, very much anytime soon either. So potential home buyers should not be looking for big declines in mortgage rates. You should buy a house only because you found a house that you want to live in. You can't live in that house unless you buy it. We've seen demand increase generally for housing, both owner-occupied and renter-occupied. Now, in the rental market, we're able to see the increase in renting activity. In the home buyer market, the problem is that the existing homes haven't been put on the market because the existing owners don't want to put themselves into a higher rate mortgage. So that's still a problem. What we'll really have to see is that the existing home owners have to understand that they simply don't have an asset that is worth as much as they were hoping it would. And that will help them to put more inventory in the market, and that will help the entire market.
How might that lead to regional shifts as well from what you're tracking, Brad?
Well, a lot of the demand that we've seen is demand from people moving from one part of the country to another. And so certainly, you know, my company is most active in the southeastern part of the U.S., and we're still seeing increase in migration toward the southeast, and that's increasing demand for housing on the owner side and on the renter side. But the biggest increase in demand, I think, is coming from the tendency of people to move out of their parents' basement, move out of the house they've been sharing with their fraternity brothers. And so I think that's going to continue, and that doesn't depend on mortgage rates. What mortgage rates and house prices determine is whether those people who are moving out from the basement are going to move into a rental unit or try to buy a house. And it's just really hard to buy.
Yeah, Brad, it's extremely hard to buy right now, given the fact that home prices have risen so much, given the fact that mortgage rates are where they are today. I'm curious, since you're in the commercial real estate space, you focus on multifamily there. What are you seeing in terms of that trend line? Because we're starting to talk about multifamily more and more just in terms of some of the weakness that we have seen, not so much in your region of the country, but when you look at the country as a whole.
Well, in the rental market, what we see is more demand growth than we were predicting. And that's, as I said, those people moving out from the parents' basement. And so that's great news. Now, a year or two ago, what was resulting from that was a big increase in rents. But more recently, over the last several months, over the last really year, rents have come down, and the rent growth has been very close to zero. So we are expecting to see, now we were predicting that rent growth would be actually less than zero. So what we're seeing is that people are finding it easier to rent. They're not getting bargains in the rental space, but they're not looking for bargains because they can't get those in the owner-occupied space either. But what they are seeing is that they're able to move into a rental place without paying the astronomical prices that they would have to pay if they were trying to buy.
Is wage growth keeping pace with what you're seeing in the rental space? And then on the other side, I guess, as well, added for anyone who is trying to purchase a home or trying to get into a mortgage stretched out over 15 or 30 years, whatever that looks like. How are wages keeping pace with that?
Yeah, wage growth and income growth have been very, very strong. And so when I look at house prices, if we hadn't seen such a big increase in wages and income, I would be very concerned about a bubble in house prices. I'm not, because of the fact that income growth is supporting it and wage growth is supporting it. And so what we're seeing is that people they're not used to paying so much in rent. They're not used to paying so much for a house, and they're certainly not used to paying so much for a mortgage to buy a house, but they're able to afford it. And that's what's making it possible for them to form a new household and start looking for housing, whether it's owner-occupied or rental.
Brad Case, great to have you. Hope to have you back here on Yahoo Finance soon. Middleburg Communities, a chief economist. Thanks so much.
Thank you.